I was driving in the car listening to this podcast and I had to write down because I was just like, you know what, it was something you said and it was just an insight and maybe we could use it kind of as a springboard for this conversation because that conversation did talk a lot about the economics of real estate and where we find ourselves today. And what you said was demand as loosely described as real GDP growth is up 3%, and goods, as loosely described by industrial output, are down by 1%, and services, as loosely proxied by employment, is 1% short. Demand is up, supply is down, prices go up. Can you break that down for us? What we're talking about here?
Yeah, I think you broke it down really well. I think there is very real inflation. The very real inflation started to occur. Let's just do a quick review. 2020, 2 years ago, things are shut down. Like a third of the economy is shut, not just slow, shut. And then another third is really slow, but not shut. And then another third is working. Well, when you shut things, there are ramifications of that. So for example, 2 years ago, the price of oil is like $5, $10 a barrel. So what do you do with the tar sands? Shut them down. What do you do with the fracking? Shut them down because they aren't even close to break even. I'm just taking those as dramatic examples. Then what happens is, fortunately, the economy, I'm talking about the US, but I think the Canadian, pretty similar, by very late 20 and then through 21, starts growing, and it grew faster in its comeback than supply came back. Now, that's not surprising when you think about it because things are really awful. Do you expect supply to lead demand? No. Common sense says I wait to see if things are really there before I expand and bring on capacity. So what you've got is real GDP, kind of a crude metric of US demand, up 3.2% versus pre-COVID, not annually, the 2 years since COVID began. And goods output is down 1%, as you say, and employment is down 1%. And as you said, you don't have to be a genius to figure out supply down 1% from where it was in 2019, demand up 3.5%, prices are up. Now you could have a long discussion of which prices and how much, some more than others. It's that simple. When will price inflation moderate? Pretty simple. When supply catches up. Now there's this notion that we have to cool demand. And I asked people, would we be better off if we had no inflation right now and GDP was also down 1% over those 2 years? By the way, if real GDP was down 1% and industrial output was down 1% and employment was down 1%, do you think we'd have much inflation right now? No. Would we be better off? Absolutely not. We'd be 4.5% worse off. So you go, okay, it's a good thing. In fact, not only is it a good thing, it's a staggeringly amazing thing that after the last 2 years, where we shut down huge swaths of the economy, political division, COVID killing millions of people, many more getting sick, absenteeism at work, social unrest, a war now, name all the stuff that's happened, and we're 3.5% or 3.2% larger as an economy than before. That's amazing. But left to its own devices, it would have been up about 5.5%. So demand's not overheated. If real GDP was up 10%, then I'd say that's overheated. We can't do that. But we can do 5 to 5.5% over a 2-year period. We've only done 3.2%, underheated. We still need demand to keep driving forward. We don't want to slow down demand. We want to encourage supply. So if we were going to do policies, the kind of policies we need are, and I'm just giving as an example, I'm not proposing them. You drill an oil well this year, or you start pumping from a well that isn't pumping, you could write it off in a year. Right, you think you get more exploration with that as an incentive. Or if you hire somebody, you net expand your employment, you get a $4,000 tax credit. Or if you come back to work after not having worked for six months, all of these I'm just making up as examples, you get a $2,000 tax credit as an individual. You think we'd bring back more labor? Do you think we bring back more capacity? And as we did, what would happen to prices? They go down. So I don't think this is about demand. It is in some tautological sense. It's about supply has made an amazing recovery from a shutdown, but still lags. And I don't know how monetary policy gets us to bring back capacity faster. That's a real activity, so to speak. So that's how I see it. And it has some ramifications for real estate. Your construction costs are really going up, right? I mean, that's not an imagination. But on the other hand, so are your rents, so are your property values. And you have to take the whole menu. It's like when you played cards and you got 3 aces and a 2 and a 3. Hey, that's a pretty good hand. You got 3 aces. Be happy. Don't gripe about, gee, I should have 4 aces, right? All things considered, pretty good here.
So when it comes to real estate, from the point of view of a couple variables, there's inflation in the general economy that people just seem to be continuing to worry about time and time again. This time it's different, as Howard Marks would titles each one of his chapters in his latest book. But what I'm curious about is, from a real estate perspective, we have the valuation of the real estate asset, and we have those prices in our markets and a lot of other major markets in North America going up. And the concern is that these cap rates get compressed and compressed. How much lower can these cap rates get compressed? What I'm curious about, is it going to be the valuation that gets out of control, or will it be the affordability from a rent perspective that you see as the governor, so to speak, in that dynamic?
Ultimately, it's the fundamentals, and that would go to more to the rent side. Price is just an outcome, right? Price is the value of a property is the combination of the supply and demand for space, right? Namely, income and rent and occupancy, and the supply and demand for money to buy income streams, right? And they don't necessarily always align. We're in a period where the supply and demand for space, rent and occupancy, is in quite good shape, unless you're in senior housing, unless you're in hospitality, still lagging, unless you're in bad retail, unless you're in office where you don't know if people are coming back to the office. But if you're in apartments and warehouse and good retail, quite good, rent and occupancy side. Now on the capital side, what's happened is QE1, QE2, QE3 after the financial crisis put unprecedented amounts of money into the system. And you saw it coming out in 2014, 15, 16, 17, 18, 19. And that money searching for a home pushed down cap rates. And everybody kept saying, oh, cap rates are going to go up. Cap rates. I kept saying, no, the weight of money is going to push it down. Now we've even put in a lot more money in addition into the system. What do you think happens when that money comes out? When that money comes out, it's got to find a home. So for example, we have record personal cash holdings. We have record corporate cash holdings. We have record dry private equity capital. We have record dry uncommitted money at sovereign wealth and pensions vis-a-vis real estate. And we have record unused bank reserves. What do you think happens when they may still be at record levels, but a little lower record levels? And the answer is that money's going to find a home, and it's going to find it buying cash streams. Some of that is on the stock market, some of it is real estate, some of it is gold. And I think cap rates go down. Now, do they go down every day? No. And people say, well, how much lower can they go? Things can always go 2% lower. It's one of the things that, remember when you learned about penny stocks and somebody said, how can you lose? They only cost a penny. And you go, well, they could go to a half a penny, right? They could go to a quarter of a penny. So how can the cap rate go lower than 3.7? Well, it can go to 3.6. It can go to 3.5. And the reason is the weight of money. So what do I mean by the weight of money? The example I use, the thought experiment. We've done a lot of statistical work on this that I won't go into. It's in Linneman letter, it's in other stuff we've written. But here's the thought experiment. It's very simple. Suppose I told you a year from now, $4 trillion, I don't care if it's Canadian or US, $4 trillion in addition to the amount already invested is trying to invest in apartment buildings, okay? What do you think will happen to cap rates? They'll go down. By the way, you didn't ask what's the economy like. You didn't ask what are interest rates. You didn't say is the yield curve inverted. You simply said, well, that kind of money, it's got to find it. It's going to bid up the values, bid down cap rates. Now flip that thought experiment. Suppose I told you that a year from now, $1 trillion is exiting apartment buildings. By the way, you could apply this to any property category. And you'd say, wow, that's going to be a problem. $1 trillion trying to get out is going to crush values. And you go, you didn't know what interest rates were when you made that insight. You didn't know what the economy was. The point is the weight of money. And we have put unprecedented amounts of money in, and it hasn't really come out yet to speak of. And it will. And it will be asset price inflation, not goods and services.